Good evening, everyone. I am CA Manisha Luthra, and I welcome everyone on behalf of the taxation TAQRB. Constant hard work, focus, commitment, and dedication are the ingredients that go into making a chartered accountant. A very warm welcome to all the honorable guests, all the chartered accountant members present over here for the very exciting webcast, Tax Audit and Accounting Standard, which is our Tax Audit Practice Session 11, organized by Tax Audit QRB ICAI. I now invite CA Raj Chawla ji, Central Council Member, Chairman, TAQRB, to give a welcome address to all of us.
Good evening, everyone. I welcome you all in this today Tax Audit Practice Series 11, Tax Audit and Accounting Standard. Today we have with us CA Shivam R. Gadgil ji and CA Sharad Gore ji, and also we have with us CA Kashinath ji. So friends, as you all aware that TAQRB brings out this series of webinar in helping and guiding the members for enhancing and improving the quality of tax audit. In today's session, the speaker would highlight some of the key issues relating to accounting standard that need to be taken care while performing tax audit. I am sure that today's session would help out members better understand the applicability of accounting standard in the tax audit. Now, without further any delay, I would request the moderator to take over the session.
I now invite CACMA Shivram R. Gadgil ji, who is the MCOM, LLB, ACA, CS, ACMA, NET, JRF, Diploma in Banking and Finance of IIBF. He has conducted various counseling sessions at Pune University and is also a visiting faculty at Symbiosis College and Sir Parshuramji College. Handing over to you, sir, to address our audience.
Thank you, Manisha. So, as Sir Raj Chawla sir said, that today's session will be pointing out certain important aspects of the accounting standards in the tax audit report. To further clarify from my side, that in my presentation for 1 hour, I will be going to cover certain basics of aspects of tax audit first, and then just keeping it with respect to AS, what I have did is I have taken a comparison of accounting standards ICDS and tax audit report in the presentation. So it will be a mixed bag of AS versus Ind AS versus any differences in Income Tax Act. So first, there are certain provisions, basic provisions, which I have touched upon, because keeping the entire session on pure AS will be very challenging. So what I have did is I have kept certain general points first, and then I will be discussing, and we will have a fruitful discussion on accounting standards vis-a-vis ICDS and their implications in the tax audit report. So just give a second, I will be sharing my screen. Manisha, is the screen okay? Okay. So let's start for the today's session on the discussion on key issues in tax audit report. Tax audit report AS and ICDS implications. So the first, this slide which is visible on the screen is just a basic information of when tax audit started, because we often keep on doing many tax audits, but when it started, what is the scope and how comprehensively it covers the areas is what is reflected in this slide. So basically, tax audit, the concept was brought in from 1984-85 budget, and section 44AB was inserted in 1984 budget. Now, we all know that the report is to be prepared in 3CA, 3CB, and the financial information which is required to be given by the auditor is in the form 3CD. Now, as the scope today is very much extended, as it covers almost many aspects of the Income Tax Act, to say that the special audit under section 142, what information it covers, the same information in similar comprehensive information is covered under 3CD as well. So as a tax auditor, we have to take adequate care that we are comprehensively reporting what is required. Another important thing is, what I felt is, when we are doing tax audit, we often step into the shoes of assessing officer. So we ourselves take some decision that, okay, this is taxable, this is not taxable. It happens when we are working on a particular assignment. So in this case, we have to take care that we as a tax auditor are just an aid to the department. So we are just the professionals who are going to independently furnish the information what is required under the tax audit. And so that is a very important aspect, because why this is important, when it comes to certain disclosures of observations in 3CA, 3CB, we have to take care of what we are disclosing, what should be disclosed, and what is expected from Income Tax Department, as well as ICAI guidance notes and other guidances. So all these things are to be kept in mind when we do the tax audit. Now, the tax audit, as we all know, is addition to all other audits applicable to SSC under Income Tax Act. So if ATIA, ATIB or any other such sections are applicable, tax audit report will be an addition report to such reports and audits. Now, what is the applicability? So just I will brush up the basic theme of the applicability. So as we all know, the applicability of section 44AB is 1 crore. So when the sales turnover or gross receipts exceed 1 crore, the person or the assessee is required to conduct the tax audit under section 44AB. Then the proviso was inserted stating that if 5% of the cash receipts or the total cash receipts does not exceed 5% or cash payments does not exceed 5% of the total respective receipts and payments, gross receipts or turnover and all payments, then the limit or the threshold of 1 CR is substituted by rupees 10 crores. So these are the basic two themes on which tax audit is applicable. Another important applicability is the professionals who are having gross receipts exceeding 50 lakhs. So they are automatically covered under 44AB. Then comes the two important provisions, that is presumptive taxation. So 44AE, BB, Triple B and ADA who are declaring lower income are also liable under 44AB. And from AY 17-18, if 44AD4 is applicable, then again it comes to tax audit under 44AB. So this is brief applicability of the tax audit, and tax audit is required to be conducted under these specific provisions. Now focusing on majorly on the 44AD4 part, as we all know that if the person in any of the previous year has taken the benefit of section 44AD1, and if for further 5 assessment year, if he is not showing any of the assessment year, he is not showing the income as per the provisions of subsection 1, then he is required to maintain books of accounts and also carry out audit under section 44AB. So this was the new amendment which was prescribed from 2017-18 AY, and that's why it becomes necessary for such persons who come under clause 44ADA4 to take their books of accounts audited under section 44AB. So that is the brief applicability of section 44AB. Now coming to clause 8, selection of clause. Now this is very important part, because if a wrong clause is selected, it might have certain implications in future. And that's why it is very much necessary to select correct clause as per the options available in the drop down. So if threshold, if the assessee is exceeding the threshold, that is 1 crore, so 44ABA is to be selected. If threshold is between 1 to 10 CR and cash receipts payments, that conditions are satisfied, again 44ABA. If threshold is exceeding 10 CR, then also 44ABA. Then comes to the profession, if exceeds 50 lakhs, 44ABA B. Then for 44AE, BB and triple B, it is 44ABA ABC. Now if the assessee is declaring lower income with respect to 44ADA, then he has to select the clause 44ABD. And if the tax audit is applicable by the virtue of 44ADA4, then comes into picture the clause 44ABE. Now, if the assessee is covered under any other audit and not under the Income Tax Act, then you will have to select the third proviso to section 44AB, audited under any other law. Now, in the guidance note also, they have given this, that there is a common mistake which is observed by the board, that when it comes to companies wherein statutory audit is applicable under Companies Act, many a times instead of selecting correct clause, that is third proviso to section 244AB, 44ABA or ABB is getting selected. So that is again a common mistake which has been observed by the board. Now, when we say why to choose the correct option, there are many implications if you choose incorrect option. Now, there are certain cases wherein tax audit is applicable because you are not declaring income as per presumptive taxation schemes, that is 44AD or 44ADA. Now, in such cases, TDS applicability changes, and that's why it is very much important that you choose a correct option from the drop down. Otherwise, that might lead to some other implications as well. So this was the basic concept relating to which clause to be chosen. Now, I am not going in detail with section 44ADA4 because that is not the part of today's discussion. And to cover that entire aspect, maybe the entire 1 hour may be required to check the applicability of 44AB with certain examples. So I am not going into that details, but briefly what options are given, I have just touched upon. Now the next concept, which is very much important, that is the concept of sales turnover and gross receipts. Now surprisingly, these all terms are not defined anywhere in Income Tax Act. So we have to refer other acts, we have to refer our guidance notes, and also any other material, statutory material or any other material which is available for this purpose. Now we all know that GST defines the turnover in a state or turnover in a union territory in a different manner. So basically it includes all the types of supplies, inward supplies, exempt, except reverse charge basis. So this is one definition given under the GST Act. Another definition which is given under Companies Act, section 2 subsection 91. So they say turnover means gross amount of revenue recognized in the profit and loss account from the sale, supply or distribution of goods or on account of services rendered or both by a company during the financial year. Now, why this point I have touched upon is that there are many aspects which we have to deal when we are when we are calculating the turnover or sales or the gross receipts for the applicability of section 44AB. Now there are certain implications such as sale of fixed assets, sale of other assets, then partner's remuneration is there, then partner's profit from his partnership firm, interest received from partnership firm, then discounts. There are n number of discounts which are given to the customers. So what are the implications of these items and elements in determining sale turnover or gross receipt is to be checked so as to get a correct amount of turnover for the applicability of section 44AB. So as I said, there is no definition given in any law, in Income Tax Act, sorry. So we have to refer the other laws and also the guidance notes, and specifically the guidance note given by ICI on tax audit. Now, certain key issues. So now discount allowed in sale invoice. So again, this is to be reduced from the turnover. Then cash discount. Now cash discount is not in relation to a trade discount or any trade transaction. It is purely a financing charge. So it is not to be deducted. Then turnover discount. Now turnover discount is given after a certain period of time when a particular amount of supply is achieved. Now, even if it is given after a particular period of time, the guidance notes clearly states that it is in the nature of trade discount, so you can deduct it from the turnover. Then special rebate. Now, special rebate can be of any nature, but if it is in the nature of trade discount, then we can reduce it from the turnover. Goods return even pertaining to earlier financial years. So again, there are certain transactions wherein goods are returned after the financial year is completed. So after 31st March, maybe there is a goods return from the customer. Now, when we are dealing with these issues, we can rely on the guidance given in the guidance note. Sales proceed from property, fixed assets, shares, securities, debentures are not included. But in this case, shares, securities and debentures are to be held as an investment. Now again, there is a big debate on whether the shares and securities are to be treated as business asset or as a non-business asset. So there are certain CBDT circulars, there are certain case laws wherein courts have given the guidance as to when we can treat shares and securities for the purpose of business income. Now in special transactions, wherein say speculative business, we have to determine the turnover. So as per the guidance note, it states that it is aggregate of positive and negative differences. The same principle is applicable for derivatives and futures, and for options, the total premium which is received is to be added for the purpose of determining the turnover. So aggregate of positive difference and negative difference is your turnover for the purpose of section 44AB only, and it is not for any other purpose. Then for delivery based transactions, the value of sale to be considered as turnover. So these are the three items which are a little bit special items when it comes to tax audit, and the turnover determination is different. So I hope the majority of the audience have a basic idea about this. Now, as I said, share, securities, business or capital gains. So basically, the treatment given is very important. The nature of the shares and securities held by the SEC is also important, and thus it becomes very essential to look at the nature and treatment given in the financial statements, and also the intention of holding behind such shares and securities. If they are for the trading purpose, then it will form part of business. But if they are for the investment purpose, then it will form the capital gains. So these are just the basic facts. If anyone wants to refer any specific thing, they can refer to the case laws given in this slide. So there are case laws in which they have clearly mentioned how to distinguish between a business, share securities classified under business or classified under capital gains. The next thing is the gross receipts. So again, the gross receipts is not defined anywhere in the Income Tax Act. Now, again, there are many things which are added in the gross receipts when we are drawing up the P&L and our financial statements. So for instance, dividend on shares, interest on investments, rents, etc. So the basic principle works here. What business we are doing, we have to add only those receipts relating to the business. That is the simple thing. If we are into if we are into renting the premises as a business, then the rent will be the gross receipt, but otherwise it will not. So this is the just basic thing relating to gross receipt. Now other specific aspects can be referred in the guidance note of ICI. So the guidance note of the ICI has given a list of many such items and their treatment, what to be done in the gross receipts part. Now coming to the tax audit part, so clause 1 to 8 and clause 9. So again, these are just basic clauses, the basic information about the SEC assessment year, then all the things are given by the auditor. So basically GSTN numbers, other registration numbers are there, which are furnished in these clauses. Clause 9 is applicable only to firm and LLP. So all the changes in the LLP and firm are to be reported in clause 9. So that is the basic part relating to the basic first certain aspects of tax audit report. Now coming to what we are dealing with today, that is the accounting standards. Now, if you on a gross level, if we see that accounting standards are not directly applicable for each and every clause of the tax audit report, because there are provisions given under Income Tax Act. But by way of introduction of ICDS in AY 1718, the AS and the AS and ICDS interplay comes into picture. Again, there can be situation where in accounting standard ICDS and Income Tax Act, there can be a conflict. So what to refer, how to report is very important. So basically, if we see tax audit report, clause 13D to 13F are basically relating to these ICDS concept. So just a brief introduction of ICDS. ICDS are only to be referred for profit and gains from business and profession and other sources. They are for computation and not for maintenance of books of accounts. Again, this is very important aspect. ICDS versus Act, always Act will supersede. There is a CBDT circular to this as well, and it clearly states that ICDS versus Act, then Act will always supersede with the provisions. So it is applicable to all the SSEs except individuals and HUF not covered under 44AB. And it is applicable only when mercantile method accounting is used. So if a particular SSE is using a cash method of accounting, then eventually ICDS will not come into picture for that specific SSE. So there are total 10 ICDS which are prescribed by the Act, and basically ICDS 1 is relating to accounting policy, 2 is for inventories, 3 is for construction contract. So we all know the subsequent As for these all ICDS. So for ICDS 1 there is AS1, for 2 there is AS2, 3 there is AS7, revenue AS9. So all these things are there. Now basically there is not much difference between ICDS and AS. Majority of the principles are same, but there are certain differences, say in tangible fixed assets, even in accounting policies, borrowing cost, then government grants, etc. For today's discussion part, I have considered ICDS 1, ICDS 2, 3, 4, 5, 7 and 9. So I have considered accounting policies, valuation of inventories, construction contract, revenue recognition, tangible fixed asset, government grants and borrowing cost. For today's discussion, only these we will be touching upon the difference between AS and particular ICDS. Now, in case if there is a conflict between ICDS and judicial pronouncements, so what to refer and what will supersede? So there is a case law, Chamber of Tax Consultants versus UI 2017. So in that, Honorable Delhi High Court has said that ICDS cannot have an override the binding judicial pronouncement or the provisions of the Act. So if there is a binding judicial precedents available, then the ICDS cannot override it. And in this case law itself, the Honorable Delhi High Court has struck down various provisions of ICDS which are in conflict with the judicial precedents. So basically, ICDS will never supersede the law, the act. They are just an assistance for determining your income and disclosure part for the income tax purpose. That is the only objective. Now coming to ICDS versus ICDS 1 vis-a-vis AS 1. So AS 1, we all know that there is a fundamental accounting assumptions of going concern, consistency, accrual. It also considers prudence, substance over form, and materiality. Now, for the concept of materiality, AS1 recognizes the thing called materiality, but ICDS does not consider or does not give any consideration to the concept of materiality. So even an item which is not material has to be taken into consideration when you are determining the income under the ICDS and the Income Tax Act. So even if it is not covered under the AS1 due to non-material, then also it might get covered under these things. Again, as per the technical guidelines of ICI and ICDS, the guidelines says that ICDS is not merely a disclosure standards. It is income computation standard. So income computation is also an important aspect of the ICDS. So we have to consider these adjustments when we are reporting in the tax audit report. So why we are touching these points? Because there will be certain differences between AS and ICDS. And to deal with those differences, we have to do some adjustments and report those adjustments in the tax audit report wherever required. So that is the simple logic why I have taken those points which are in contradiction with each other, ICDS versus AS. Now, coming to the next point in AS1 and ICDS 1. So there is a concept of mark-to-market loss. Now, this concept is not at all permitted under ICDS. Even the same logic goes for mark-to-market gain. So AS permits MTM loss to be provided, but this provision is not at all applicable or not permitted under ICDS. So there can be a point wherein you will have to make adjustment for these particular item which is permitted by AS1 but not permitted under ICDS1. So this is the first and important point for difference under the ICDS1 and AS1. Now coming to ICDS2 vis-a-vis AS2. So basically in both the standards, the concept is same. Even ICDS and AS2 both prescribe that cost or net realizable value, whichever is lower has to be the value. So there is no contradiction in this. But there is an exception in ICDS, and it says that materials and other supplies which are used in production of inventories should not be written down below the cost if the finished products in which they will be incorporated are expected to be sold at or above the cost. So basically, if a particular material is used in the production of inventories, then there is no requirement to write down below the cost if the finished good is, if the SSE or the finished goods is able to be sold above the cost. So there is a contradiction between ICDS2 and AS2. Now this also might give may require certain adjustments to be done and reported in the tax audit report under 13F. So this is relating to ICDS2 and AS2 first difference. The second difference is that the borrowing cost directly related to the inventories. Now, ICDS does not require to include borrowing cost in the cost of inventories unless they meet the criteria for recognition of interest as a component of the cost as specified in ICDS on borrowing cost. So ICDS borrowing cost, the principle of recognition, if it gets satisfied, then there might be a situation that such borrowing cost, which is directly attributable to the inventory, might be added in the inventory cost. So this is as per ICDS 2. Now, when we come to AS2, AS2 states that usually these borrowing costs are not relating to the bringing the inventories to their present location, so they are not to be included in the cost of the inventories. So AS2 has clearly stated that it is not required to be included in the cost of inventories. But ICDS 2 also states that it is not to be included, but if they meet the criteria, the recognition criteria under ICDS on borrowing cost, then they will have to be included in the component of the cost. So again, there will be some difference between the inventory as per ICDS 2 and AS2. So we will have to draw the adjustments as required, and we will have to report such adjustments in the tax audit report. Now the next important difference is the duty drawbacks. So AS2 specifically states that the duty drawbacks which are received should be deducted in determining the cost of purchase. But ICDS in connection with 145A2 of the Income Tax Act differs on this, and they do not allow to include these duty drawbacks. So again, there will be a difference of the value of inventory as per AS2 and ICDS 2. So again, this will lead to some adjustment which might be required for the purpose of tax audit reporting. So AS2 and ICDS 2 go hand in hand in almost all the cases, but there are 3 to 4 important differences which in general result in adjustments and reporting under the tax audit report. Now coming to the important part or most crucial thing, that is ICDS 3 vis-a-vis AS7. Now ICDS 3 is for construction contract, AS7 is for again construction thing. Both are mostly similar. If we see the provisions of ICDS 3, the provisions are mostly in line with AS7, but there are certain exceptions. Now, as per ICDS, when the outcome of the early stage of contract, not more than 25% of the stage of completion, cannot be estimated reliability income to the extent of cost incurred is required to be recognized. So when the outcome of early stage contract cannot be estimated reliably, then what cost has been incurred is to be, to that extent, the income is to be recognized. Now, A7 also provides identical condition, but there is absence of specific criteria relating to percentage of completion of contract as against 25% in the ICDS. So there might be a situation that no income is recognized in the books in absence of reliability of estimate. But due to 25% cap, there might be a situation that income is required to be offered to tax under ICDS. So that is the interplay between the difference of ICDS 3 and AS7. So ICDS clearly states the percentage, but AS7 does not have the percentage. The rest provision is totally identical, but the percentage is not mentioned in AS7, which may give rise to adjustment and reporting under tax audit report. The next thing is relating to retentions in contract revenue. Now AS7 is silent about including whether to include or not to include retentions in the contract revenue. But ICDS 3 clearly states that for the purpose of revenue from the contract, amount of revenue agreed plus amount of retentions has to be recognized. Now also this will lead to differences between the amount reported under AS7 and amount reported under ICDS 3. So again, adjustment might be required and reporting under this clause will be essential. So ICDS 3 and AS7, the next difference is the expected losses. Now, as I already discussed in ICDS 1, that expected losses is not allowed to be recognized as per ICDS. But AS7 has the provision for expected losses to be recognized in the financial statement. So there might be a situation that the tax auditor will have to draw adjustment relating to actual losses and expected losses, and then the adjustment is to be reported under this clause. So this might give rise for adjustment under tax audit report to be reported in this clause. Now, the next slide is relating to what disclosure requirements. Now, why I have taken this point is that because these are the specific disclosures which are to be made for ICDS 3. So the tax auditor has to take care that these disclosures are made in the ICDS 3 part. Now the next ICDS and AS is ICDS 4 vis-a-vis AS 9. Now there is a fundamental difference between one important difference rather in ICDS 4 and AS 9, that for services AS 9 also gives an option on completed service contract method, but such option is not available in ICDS 4. It only applies POCM. So if for the fact AS 9, as per AS 9, the SSE has considered the revenue as per the completed service contract method, then necessary adjustments will have to be made to bring it to the POCM method. And this part is often neglected while reporting in ICDS 4. So when we are reporting for ICDS 4, we have to take care for this particular difference, ICDS 4 vis-a-vis AS 9. So this is again a very important part. Now coming to the ICDS 5 and AS 10. Now AS 10 again uses words materiality and judgment. So if a particular tangible asset which is very low in value due to lack of materiality may be expensed out. But as we already discussed, that as per ICDS 1, materiality is not considered. So even a smallest item or a low value item has to be considered while calculating the income. So if a particular tangible asset due to its very meager value may be expensed out in AS 10, but the same thing may be capitalized as per ICDS for the income tax purpose. So again, there will be a situation as per accounts it is expensed out, but as per ICDS it is capitalized. And so we will have to draw the adjustment and report it accordingly. The next thing under this ICDS 5 and AS 10 is that AS 10 provides that if there is a cost for replacement of a part of an asset or a major replacement is to be done, then the same is added to the carrying amount if it meets the recognition criteria. Now we will first have to understand that the recognition criteria under AS 10 is different vis-a-vis the recognition adopted by ICDS. So there might be a situation that certain replacements are recognized as a and added as a carrying amount in the asset as per the AS10 or for the purpose of accounts. But the same thing may not be equally done under the ICDS, because ICDS states that when there is a subsequent expenditure that has to be added to actual cost, it is only possible if the future benefit is has increased from the existing asset beyond its previously assessed standard of performance. So what was assessed previously, if that benefit is increasing due to this additional expenditure or subsequent expenditure, then only it can be added to actual cost. Otherwise, it will not be added to actual cost. So there is difference between how to recognize the subsequent expenditure. In AS10, it is recognition criteria. In ICDS, it is the assessment that has to be checked, and whether there is increase in the benefit that has to be checked, and then only it can be added to the actual cost. Now there are certain aspects relating to dismantling, site restoration for the purpose of cost of assets. Now we all know that AS10 considers these costs to be added in the cost of asset. So for example, if there is a dismantling to be made, or there is a future site restoration to be done after the asset is installed, then that cost will also form part of cost of asset. But ICDS 4 does not recognize any such future cost. It only considers actual value, actual cost. So again, due to such amounts, say for dismantling, site restoration, or such other future expenses which are related to asset, may get added in AS10 but will not be recognized for the purpose of ICDS 5. So there will again be a difference, and there might be a chance that we have to do the adjustment. We have to take the adjustment and report it to in the tax audit report. So this is another important thing. Now the last point relating to ICDS 5 and AS10 is that if the tangible asset is acquired in exchange of shares and securities, so instead of cash, it is exchanged in shares and securities, then the treatment in both the standards is different. Under AS10, it says you take FV of shares and securities or FV of tangible asset, which is more evident to be recognized. So out of these two, which is more evident should be recognized as the cost of the asset. But if we come to ICDS part, it states that fair value of the tangible asset shall be its actual cost. So no consideration is given for the fair value of shares and securities. So again, there will be a difference, because if fair value of shares and securities is more evident, AS10 will require that FB to be recognized for the purpose of that asset. But ICDS will not allow the same, and there will be difference between the two. So again, reporting might be required for the same. Now coming to government grants and AS12. So ICDS 7, that is relating to government grants, and AS12, which is for the accounting standard for accounting of government grants. Now, before considering difference between AS12 and ICDS 7, there is a fundamental difference between the Act and the ICDS 7, or the judicial pronouncements versus the ICDS 7. Now, what the ICDS 7 says, it says that government grant should not be recognized until there is reasonable assurance that all the conditions will be okay and grant will be received. So till these two things are not there, don't recognize the grant. The same principle is given by the AS12. So there is no difference. But in ICDS, there is a ICDS 7, there is a clause which says that recognition of government grant shall not be postponed beyond the date of actual receipt. So once you have received it, you cannot postpone the recognition. This is what ICDS 7 says. Now there is no such thing in AS 12, first point. Now, if say for example, a particular SEC has received the grant, but there is still doubt and there is no reasonable assurance that the conditions attached to the grant will get satisfied and the grant will be eligible to be received. Now in that case, what to do? Because ICDS 7 will say, as you have received, you have to recognize. But there are certain case laws of the Supreme Court wherein absence of right to receive is regarded as a basic factor for recognizing the income. So if there itself there is a doubt of right to receive a particular grant, there might be a situation that we have to follow the guidance given by the Honorable Apex Court. So there is a difference between ICDS 7 and what has been given under the judicial pronouncements. So as I said, naturally the pronouncements will supersede, but there might be a situation wherein the tax auditor will have to think of reporting it under this clause as well and any other area where this reporting can be done or disclosure can be made. The next thing is now coming to the specific difference of ICDS 7 and AS 12. Now for the government grants with respect to depreciable assets, now as per AS 12 we have two options. We all know either we have to reduce it from the cost or we have to defer the income systematically over the useful life. Now ICDS 7 allows only first option, that is to reduce from the cost of the asset. It does not treat the second option valid. So there might be a situation that the SEC has gone for the second option as per AS 12, but because ICDS 7 is not allowing for the second option, there might be a chance of adjustment required to be made and reported under the clause. Now the next thing is relating to promoters' contribution. Government grants in nature of promoters' contribution. So what AS 12 says, it says that it has to be credited to the reserve account. ICDS has a different aspect to this. So it states that proportionate portion of the government grant shall be deducted from the actual cost or WDV in the prescribed manner as per given in ICDS 7. So again there is a contradiction. One says, AS 12 says, show it as a reserve in the credit to the reserve account. And ICDS states that it has to be deducted from the actual cost in proportionate manner as prescribed under ICDS 7. So again, there is a chance of adjustment to be made and reported under ICDS this clause. Now the last ICDS and AS which we are dealing today is ICDS 9 versus AS 16. So basically these both are relating to borrowing cost. Now the major difference between these two standards, ICDS 9 and AS 16, is that the 12 months criteria in AS 16. So borrowing costs are added in the asset cost of asset when they are directly attributable and the asset takes a substantial period for development, for creating that asset. So such criteria is not there in ICDS. It says if the borrowing cost is directly attributable to the asset, you have to consider the borrowing cost and add to it. So there might be a situation under ICDS, because it is directly attributable, we have capitalized. But in accounts, as the asset does not satisfy the 12 months criteria, it is not capitalized. So again, there is a rise for adjustment to be made for the purpose of this particular difference. So the 12 months criteria is very important, which is only stated in AS 16 and not in ICDS. The next part for of difference between this ICDS 9 and AS 16 is that income on temporary investment of borrowed funds, which are specifically borrowed for obtaining a qualifying asset, can be netted off from the borrowing cost. So AS 16 allows to net off the income which is received on temporary investment from the borrowing cost. Now such netting off is not at all allowed under ICDS 9. So again, due to AS 16, there might be a chance that the SEC has netted the income which is earned on temporary investment from the borrowing cost. But the same will not be allowed under ICDS 9. So we will have to do the adjustment and report under the clause. The next difference between these two standards is suspension of capitalization. So AS 16 allows for suspension of capitalization, but ICDS 9 does not have the provision for suspension of capitalization. So again, that might lead to certain adjustments to be reported under this clause for this purpose. So this was all relating to ICDS vis-a-vis AS. We have only covered 1, 2, 3, 4, 5, 7 and 9. So that only ICDS we have covered. Now 2-3 points more I will be sharing today for the tax audit report purpose is the real estate transaction. So there is clause 17 which states that, which basically deals with 43CA and 50C. So 43CA and 50C 110% of that part, or in some cases 120% as well. But as a tax auditor, we will have to report all the cases wherein the consideration is less than the stamp duty value assessed by the authority of the state government. So we are not concerned about whether it is exceeding or not exceeding 110% or 120%. That is the lookout of SEC. We are certainly required to report transactions wherein the consideration for transfer is less than the value adopted or assessed or assessable by the authority of the state government. So we are not concerned with whether 110% cap is there, 120% cap is there. We are not concerned for that. So we will have to report it accordingly. Now also there is provision for genuine transactions. So there might be a situation that SEC might get valuation report and prove that why the consideration is lower than stamp duty value. So these are all for the assessee aspect and not for the auditor aspect. So we will have to report if the condition given in clause 17 is satisfied, we will have to report in clause 17. Then the next thing is clause 20B. Now this is only for clerical things, as you all may be knowing, or some of you have faced these adjustments under section 143(1). If there is any misreporting in clause 20B, now clause 20B relates to the amounts which are taken from the employees for specific funds, say for PF, ESIC, etc. So if there is a clerical mistake in reporting such items, then it is directly added to the income in 143(1), and then unwanted dispute, revision in tax audit report and other implications might arise. So proper care has to be taken for clause 20B, because there are many attempts to be reported in this line items, and there is a possibility that some amount, date might get misreported, which might lead to unwanted adjustments for the SEC. And the problem is that once the adjustment is done, it is very difficult to get back the adjustment. We will have to file revised tax audit report maybe, or there is some other way out for that. We will have to resort for that. Another small aspect relating to standards on auditing 700. So basically, if you refer the guidance note, the basically 700 SA 700, which is forming an opinion and reporting on financial statements, there is a specific importance to the responsibility paragraphs from the perspective of the readers of the particular audit report. Now, there is no facility for reporting this thing in tax audit report anywhere given by the income tax department. So as a part of guidance note from ICI, we have to report it in clause 3 of form 3CA or clause 5 of form 3CB, as the case may be. So if you refer the guidance note or even the common mistakes, the board has stated that this clause was not there anywhere in many reports, and also it was not reported in the specific clause which is given in the guidance note. So the care has to be taken for this particular clause. So this was all relating from my side. So I tried to touch upon certain aspects of AS versus ICDS, because as I already said in the beginning, that entire AS aspect will be very challenging to deal with as far as the tax audit applicability is concerned. So what important points I thought should have been covered, I have tried my level best to cover the same. So this was all from my side.
Thank you, sir. Happiness is starting your study
Hello,
with
Manisha.
3 principles of accounting and your profession with 3 principles of life. That is, challenge it, achieve it, loop it. Thank you to our learned speaker, CA Shivram Gadgilji, for such detailed and insightful presentation discussing about the common mistakes, basic concepts regarding the choice of right clauses, and also covering the provisions applicable to special transactions. Also bringing out the differences between ICDS and AS and linking with the perspective of guidance notes and standards of auditing too. Shivram sir, also there's a humble request to you to please share this presentation with the board at taqrb@ici.in.
Okay, sure.
I would like to announce that our technical team has just informed that right now 2860, that is 2,860 participants joined the session as the live participants. And with this, I would like to now introduce Honorable Shivaji Bikaji Zavreji. He's there with us. CA Dr. Shivaji Bikaji Zavreji, a person who needs no introduction among his members and students' fraternity. A commerce graduate from University in Pune in 1969 and a fellow member of ICAI. He has been awarded the Doctor of Philosophy, PhD, by Savitribai Phule Pune University on standardization of accounting practices in agricultural sector in India in March 2019. He has also been the former Central Council member of ICAI New Delhi. Former chairman of Accounting Standards Boards, ICAI. He has also been the former chair of Asian Oceanian Standard Setters Group for 2019 to 2021. He has been the former member of Accounting Standards Advisory Forum of International Accounting Standards Boards of IFRS Foundation London for 2018 to 2021. He is the one who is the Uden inventor and the author of ICI Forum. Sir has also got the Lifetime Achievement Award for contribution to the fields of chartered accountancy, education, administration, and social work conferred by Maharashtra Cosmopolitan Education Society and Alana Institute of Management Sciences, Pune. Apart from this, his professional contribution includes that he has also been ICI faculty for IFRS certification courses. He is a visionary and pioneer faculty in CA profession since more than 4 decades. He has been a paper presenter in many Institute of Cost Accountants of India. He was managing committee member of Pune branch of ICI during 1988 to 91 and was the chairman of Pune branch in 1990 to 91. He's a founder and life member of Pune Chartered Accountants Society. He has written many articles which have been published in Economic Times Taxman. He has been faculty to seminars conducted by ICI. He has the motto of ICI is Ya Esha Supteshu Jagriti, which literally means a person who awaken those that sleep. It is a quotation from Upanishads. We CAs keep ourselves updated with change in laws and amendments to serve best to the economy. I would now like to thus begin with our Q&A session. And my first question is from our learned speaker, that is CA Sharad ji. Over to you, sir. My first question. For an example, there's a case wherein sundry creditors include a particular creditor to whom rupees 1 lakh is payable since last 4 years. Sir, should it be considered as an income under section 41 clause 1 while reporting in clause 25 of form 3CD? What is your opinion, sir?
Thank you for kind introduction. Now, as to the sundry creditors include rupees 1 lakh, which are payable for last 4 or 5 years. And while making the assessment, generally the assessing officer consider it to be no more payable and they treat it as income under section 41(1) of the Income Tax Act. And there has always been a tussle between the assessee and the assessing officer that whether by not paying a particular creditor for a certain number of years, normally it is considered as 3 years for a limitation, whether it amounts to non-payment, therefore it is treated as income. In fact, there is a specific decision on this particular issue by the Supreme Court also in Vardhaman Overseas Limited, where after 4 years, a particular creditor being no more payable, the company transferred this amount to a capital reserve, and based upon that, the assessing officer has treated it that when the assessee himself is considering it to be as not income, not liable to pay, therefore credited to reserves account, so it should be liable to tax under 41(1). But the Supreme Court replied that it is not the case. It is a unilateral act on the part of the concerned company, so the liability does not cease to exist, and so long as the liability does not cease to exist, it cannot be considered as income and as such taxable in the hands of concerned person. So while doing the tax audit, in reporting that particular clause, what we have to ensure that even though it is a liability not being paid for many years, the only thing is that we have to take on record that this liability exists and the creditor has not remitted the liability. If creditor has remitted the liability, then in that case, for the purpose of income tax as well as for the purpose of accounting, it is to be treated as income and has to be offered to tax.
Thank you, sir. Thank you for the answer. My next question is from CA Shivram, sir. So, the question is, what is the interconnection between 80JJAA and 44AB? So, for example, if the assessee to whom section 44AB is not applicable, can he claim deduction by voluntarily filing tax audit report under section 44AB? Or we have to say simple, no 44AB, then no 80JJAA. What is your opinion, sir?
Yeah, so basically, if we refer section 80JJAA, it starts with that when the assessee is covered under 44AB, then only that additional amount deduction is available for the new employees which are employed during the previous year. So there are another 2-3 conditions to that, but from the aspect of 44AB, we have to see that there are certain companies wherein the threshold is not crossed. So ideally, they do not come under the purview of tax audit. Now, there are certain small IT companies wherein, now in IT companies, this aspect is very much common because in IT companies, new employees are always employed in every year. So for such companies who are not crossing the threshold, but they have additional employees in the previous year, then Now the point is that how we can take the deduction. So ideally, if we go for voluntarily filing the tax audit report, as I already discussed the clauses to be selected, there is no clause of voluntarily going for tax audit report. So on a conservative basis, we can say that to avoid dispute or to avoid any other implications, we can say that if the SSC is not covered under 44AB, then ideally 80JJAA will not get the benefit of 80JJAA will not be available. So that will be the case.
Right, sir. Very right, sir. The next question from you only, sir. What is to be reported in observation part in 3CA, 3CB? Only the negative or qualification remarks or generalized statements can be given. What do you say, sir?
Yes. So for the purpose of observation things, basically what ICI requires from the tax auditors is that to give specific qualifications under the observations. But now question comes. So for example, if say there is a tax applicability, TDS applicability under section 195, but due to many judgments which are divided judgments, if the SSC says that I have not deducted the tax under 195, now for this purpose we will have to report under observation thing. But this is specific qualification. But there are certain situations wherein we will have to report certain general remarks. Now, as what is required under the observations is to report only the specific qualifications or what is not complied with or what is not as per the law or the Income Tax Act. So here there is a challenge for the auditor that whether he can report certain general observations also. So as an auditor, because I am auditing the SAC, I have that right to report what I feel to be reported, so as to get out of the purview of gross negligence. Because negative things, if I am not reporting, I am obviously coming under the gross negligence part. But if for my safer side or for my purpose, if I am reporting some general points, then even though it is not required there is no harm in reporting those observations in the observation part, and it will always save the auditor from any future implication.
Right, sir. Thank you for answering. And now moving to my next question from Sharad Vazia, sir. Sir, we have certain receipts in clause 16D of 3CT. These receipts or income were already offered to tax under the other heads of income or were exempt from tax. In intimation, it is added to returned income, raising huge demand. So, should we revise tax audit report or any other remedy, sir?
No, this has been noticed especially for previous or AY 21, 22 and 22, 23, where the tax auditors have disclosed in 3CD Form 16 about the other income not credited to profit and loss account. And in that, they have included the salary, bank interest, even the sale of property, capital gains, etc., as well as interest on PPF, which is exempt from tax. Now, this has been included in 16 clause D, and while processing done by the CPC has simply added all these receipts in the income, where the salary, bank interest, or capital gains were already offered to tax in other heads of income for the same assessment year. So the taxpayers or the tax auditors were in a problem, not whether that should have been included in 16D or should not have been. Personally speaking, if you read that clause 16D, any income which is chargeable to section 28 and not credited to profit and loss account, that is to be reported, not any other receipt or any other income to be included in 16D. So basically, it should be a part of business income which is not credited to profit and loss account. That only will have to be reported. But under mistaken belief that since the salary received or PPF interest received is credited to capital account and not to P&L account, many tax auditors have reported, and the CPC has raised huge demands. So there were two alternatives available. One is rectification, and many have tried rectification, but as we are aware about the reality, in 99.99% of the cases, rectifications got rejected for the simple reason that what is the mistake apparent from record? Because rectification falls under section 154, and under 154, only mistake which is apparent from record will get only rectified, otherwise 154 has no application. Then one more question that was sought to be raised during my session with other Aurangabad to say specifically that should the auditor revise the tax audit report? I have got two doubts about that revision in tax audit report. Number one is if you want to revise the tax audit report, then one is required to follow the issued guidance note on revision on the audit report. So you have to comply with the guidance note in the revising the tax audit report. Number one, the tax audit report you may not revise the financials, but you have to revise the report. And number third, which I feel which is more important, there is no provision under section 44AB or relevant rule 6G, a provision for revision of audit report. Now that is provided in drop-down menu because you have to select whether it is original or revised. But that is a facility provided by CPC that doesn't become a law because the 44AB does not allow revision in tax audit report. So there is no alternative but to file an appeal under CIP appeal or National Patients Appeal Center. But I may point out one circular issued by the board, circular number 14. It was issued way back in 11th April 1955, almost 70 years before. And that circular is still useful. I am still using it and the relief is being granted on that issue. And the circular in one liner, I can say, the income tax department cannot take the benefit of mistakes of the SST. This was the circular in 1955. The income tax department cannot take the benefit of mistakes made by the SST or its tax auditor. So if there is mistakenly reported, which is not the income at all, which that receipt is already offered to tax, it is a mere mistake and the income tax department cannot recover tax. Income tax department cannot recover more amount than what is permitted by law. So that circular number 14 dated 11th April 1955 still available, still applicable to taxpayers, and in that particular issue only, in clause 16D, I have made use of it before the CIT appeal and he gave me the relief because it was genuinely a mistake.
Thank you for sharing such insights, sir. I'm sure that has come from your wisdom and rich experience of your practice. The next question is also from you, sir. In case where a company has given a loan or advance to a director or shareholder having more than 10% voting rights, so how to report in clause 36A of 3CD? How will this clause be reported?
So if you look at that 36A, because again, what happens nowadays in 99% of the cases, people use softwares and they fill in the information. In 36A, the heading states like whether the assessee has received any amount in the nature of dividend under 222E. So the reporting requirement is applicable to receiver and not to the payer. So if the company has given any loan or advance to a director or a person having more than 10% voting rights, mistakenly this is getting reported in clause 36A, whereas clause 36A is applicable to the receiver and not to the payer. So there is no reporting requirement, and the real fact is, suppose your client, an individual who is a director in a company and he has taken a loan from the company, and whether you are aware of it or not, if you are aware of it, then you may report it, but it's not necessary that you are aware of each and everything. You may be having a proprietary concern, and in the proprietary concern, a bank account is there, and to this bank account, which is a business bank account, the loan received from another company is credited. That means as a tax auditor, you are not aware, you are not supposed to look after his personal transactions or personal bank account, which he very well say that this has got nothing to do business, whereas you're doing the tax audit under 44AB, which falls under 28 to 44D. That means it is pertaining to business income only. So it is my personal bank account to which it has been credited. In such cases, probably the tax auditor may not know in reality whether there is such a loan received by your client. In that case, it may not get reported.
Okay, sir. Thank you. Thank you for such a detailed answer, sir, and clarifying on the question. Moving to my next question, which is from Shivram, sir. Sir, the case is loan is given of rupees 5 lakhs by account paycheck, but the person has repaid the same in cash. So whether to report the same in assessee's tax audit report, and if not reported, then what are the consequences? And what if the person to whom loan was given, his auditor discloses the same in his tax audit report? What is your opinion, sir?
Yes. So basically, the case is like the SEC has given a loan of 5 lakhs. At the time of giving the loan, it was in by way of account paycheck, so not being a cash given to the person. Now, when the person to whom the loan was given, if he has repaid that amount in cash, now the question arises whether such receipt, which is in cash, has to be reported by the SEC or for that matter the tax audit report of the tax auditor of the SEC in the tax audit report. So basically, if we go and analyze the clause 31, so basically it deals with two sections, 269 SS and 269 ST. So basically, if we read the question which has been asked in the tax audit report, in such case, if the loan, even though the loan was given by way of account paycheck, but as it is received in cash at the time of repayment, as a auditor of the SEC, I will have to report it. If I am not reporting, and if in that matter, if the person who repaid the loan, his auditor reported in his tax audit report, then there might be a situation of gross negligence on my side, because that was to be reported from the SEC's perspective as well. So this may lead to gross negligence from the tax auditor's point of view.
Okay. Thank you for clarifying, sir. And my next question is also from you, sir. Sir, can you please give a detail on interplay of clause 34 with clause 21? So there may be three situations. Number one, which is TDS not deducted. Second situation could be TDS was deducted, but with wrong rate. And the third situation could be TDS not deducted, but compliance with respect to section 2011 is given by the assessee. What is your opinion, sir?
Yeah, so basically, as far as TDS provisions are concerned, there are two main clauses in the tax audit report. One is clause 34, wherein we have to give all the details of tax deducted at source as per the sections of TDS, and the amounts are to be disclosed which are related to that particular section, the amount on which tax is to be deducted, the amount on which tax was deducted, and total tax which is deducted. So 34 gives entire details of what TDS applicability was there for the SEC. Now clause 21 also has certain questions relating to TDS, because if TDS is not done, there is a disallowance, and that disallowance has to be reported in clause 21. So there is an interplay between these two clauses. So ideally, these two clauses has to be reported simultaneously to avoid any mistake on the part of tax auditor, because if there is any misreporting, so for that matter, 34 clause, if there is misreporting, or even in 21 there is misreporting, there might be a situation of unwanted adjustments in under section 143(1), or there can be a gross negligence on the side of the tax auditor. Now there are three situations. One is TDS is not deducted. So if TDS is not deducted, then again the clause 34 will have the impact, and as well as clause 21 also will have the impact. So in both the cases, we will have to report it. The next thing is TDS deducted but with wrong rate. Now there are many tribunal decisions which are again divided. So certain tribunals decision says that if TDS is deducted but with wrong rate, then there is no disallowance. But if TDS is deducted with wrong rate, then certain decision says that the proportionate disallowance is to be made. So for example, 10% TDS was required to be made, but 2% is made. So there is a question of what about 8% which was required to be deducted. So whether that disallowance will be in proportion to 8% or disallowance will be in or there will be no disallowance. So again, there is a reporting requirement under these both clauses. And the third situation which says that, say for example, I have identified certain transactions wherein SSE was required to deduct the tax, but he has not deducted the tax. But he has provided me with the compliance that the person to whom the payment is made has offered the income to his return. He has provided the necessary compliance to me till the date of reporting. So in such cases, what has to be done? Now in such cases, so again the clause 34 will have impact, because in clause 34 they have specifically asked whether the SSE has complied with the provisions of TDS required under the law. So now there is a call for the tax auditor whether to report in 34 or to give these particular transactions in observation part. So this is a critical aspect wherein the tax auditor has to take the call for the third situation. So ideally 34 and 21 are very important clauses with respect to TDS, because in almost 99 or even 90% cases of tax audit, there is a implication of TDS. So to avoid the unwanted adjustments, the tax auditor has to take care in both the clauses simultaneously, clause 21 with respect to clause 34.
Now, Manisha, I just want to add it.
Sure, sir.
May I?
Sure, sir. Please.
See, basically, with the two issues are there, which I understand. One is a tax is required to be deducted at source under 194J, and it is actually deducted under 194C. That means instead of 10%, the TDS rate applied is 1% or 2%. Now, whether it will result into disallowance, that was number one. Number two, whether if the disallowance is proportionate or not. There are two High Court decisions on that. One is the Tekriwal case, that is of the Calcutta High Court. If citation is required in 361 ITR 432. Now, in that, the Calcutta High Court has allowed the entire expenditure, even though the tax rate is deducted at a lower rate. Now, for that, there are other decisions of the Calcutta Tribunal also on this particular issue, CP, tanneries, etc. Because the basic definition of basic concept is it is a tax deducted at source. It is not tax deducted from income. For example, if you look at 194C, if the contractor payment is 5 lakhs, TDS is only 5,000. 5,000 is not the tax on the income included in that 5 lakh rupees. In 5 lakh rupees may have 1 lakh rupees income, may have 2 lakh rupees income, and accordingly will pay. So basic concept, the spirit or the concept of TDS is number one, that it gets noticed to the, or it gets recorded with the government authorities that there is a such transaction, and naturally the person getting his income deducted, tax deducted, will have to file the return of income either to claim credit or to claim the refund of it. That is number one. And number two is the government should receive revenue regularly, and it is not dependent upon the whims, because in case of advance tax, person may pay, person may not pay, but there is no such scope. So the Calcutta High Court has read it that it is a tax deducted at source, it is not tax deducted from income, so there is no relevance to that particular allowance or disallowance. Of course, I'll prefer as an auditor that we should refer it in the observations that we have relied on this Calcutta High Court decision on so and so particular issue. Unfortunately, I'm using the word unfortunately with respect, the Kerala High Court has taken opposite decision that if there is a short deduction, it will not be allowed, or if at all if it will be allowed, it is proportionate. But I may let the viewers know that if there is a conflict of decision between two high courts, obviously for Kerala, they have no choice For Calcutta, they have no choice, but the rest of India, any decision which is beneficial to the taxpayer can be adopted, and this is going on since 1955, like Pune Valley Transport Corporation or Mother India Representation. So these decisions are, n number of decisions are available. In case of dispute between the high courts or divergence of opinion between the high courts, the view which is favorable to the taxpayer should be adopted.
Sir, can you just quote the case law, the Calcutta High Court case law?
Calcutta High Court 360.
Thank you, Sharad sir, for the wonderful clarity with interlinking of case laws and the clauses and the sections. Thank you, Shivram sir. With this, I would like to move to my next question, which is from Sharad sir. What precautions to be taken in case of transactions which are unrelated to books of accounts? For an example, deduction under Chapter 6A, Section 50C, or Section 56, like gifts, etc. What is your opinion, sir? What could be the precautions?
The basic problem is tax audit falls under 44AB. 44AB is within the group of sections pertaining to business profession. So the reporting requirement should be restricted to business profession only. That is the basic thing. Unfortunately, in order to reduce the work of the tax officers, many sections unrelated to business are getting added in the tax audit report. Now, for instance, a proprietor of a businessman whose accounts are subject to audit, a tax audit is being done by me. Now he has sold the property, and that for which the money is received, credited to his account, may not be a business account. He can have his another separate account pertaining to his personal transactions. So it is credited. I will never, in fact, I will not be aware at all that there exists such a capital gain transaction. Because as you are aware, from AFT or from AIS, the transactions in excess of rupees 30 lakhs are getting reported upon. If the transaction is below 30 lakhs, it may not get reported. So neither the tax auditor, and one more aspect, the tax auditor need not be the tax preparer. I can be a tax auditor and some other person can be a person who will file the return of income. So the person who is going to file the return of income may be having the details of capital gain transaction, whereas the tax auditor may not be having it. I'll just give one simple example. I'm the tax auditor of a foreign oil company. It is 100% held by foreigners, and I am the tax auditor of the company, and some other chartered accountant who is on the CA force sort of it, who is looking after the accounts and statutory audit. Of course, he can't do statutory audit, he is getting it done from others. Now, I have to give the tax audit report. I am uploading the tax audit report, but I have no access to his website also, to the tax return also, or I cannot have the copy of AIS, I cannot have the copy of 26S, because he says that it has got nothing to do with the tax audit. So the core tax auditor, frankly speaking, may not be having all the information, and then he is still required to give a comment on that. Now, for example, ATC, whether he has invested that 1,50,000 or not, the concerned person may not be aware of it, concerned tax auditor. So I will prefer that to include it in general observation that the tax audit and my comments pertain to business activities only, and in respect of other clauses for which I have given the information is based upon the information given by the auditor, which I have not verified. That will help a lot in subsequent if there is a negligence.
And even in this case, in case of a sole, we can even on the financial statements itself, we can mention the accounts or the financial statement are drawn for the business or professional purpose only.
Absolutely.
So that it automatically will get resolved that all other things are dealt with in the capital account, or he is responsible for that.
Yes.
So
I really appreciate your detailed and comprehensive responses to both our speakers. With this, I move on to the next question, which is from Sharad sir only. Whether trade discount is reportable in clause 23 of Form 3CD. What in case failure to meet in clause 34. Sir, how would we report it?
Now, because the basic issue is whether the trade discount is an expenditure or not. Because as we are aware, if it is a cash discount, obviously it is an expenditure because it is to be allowed at a time of cash receipt. Suppose a person has sold the goods for 1 lakh rupees and he pays the cash for 98,000 rupees. 2,000 rupees is the cash discount. We have already recorded the transaction for 1 lakh rupees. So 2,000 will be recorded as cash discount. However, if the goods are sold worth rupees 1 lakh away, then the accounting will take place for only for 90,000 and not for 1 lakh. So trade discount is not a part of profit and loss account at all. When it is not a part of profit and loss account, the question of TDS does not apply. And for that, there is a decision of the Delhi High Court. No, sorry, not Delhi High Court. That discount is not expenditure at all. That is what has been held in United Exports versus CIT 330 ITR 549. That 330 ITR 549 that was specifically with reference to 482B. The discount was given to sister concern. Now the High Court has said that discount is not an expenditure at all. So the question of applicability of 482 does not arise.
Thank you, sir. I now thank both of our speakers and extend my heartfelt gratitude to both the experts for generously providing such thorough and enlightening answers. Your knowledge and guidance are truly invaluable, sir. Intellectual growth should commence at birth and cease only at death, said by Albert Einstein. Indeed, this was a wonderful session on accounting and auditing standards by our speaker, C.A. Shivram Gadgilji, and insightful question and answer round from both of our speakers, C.A. Sharad Baze sir and C.A. Shivram sir. I now would like to invite C.A. S.B. Zavre sir for his concluding remarks. Over to you, sir.
Thank you very much. I hope, dear professional colleagues,
Javed sir, sorry to interrupt that.
Sorry.
Our Vice Chairman Chitle sir is now joining.
Right.
Chitle
no
sir.
problem.
Chitle sir.
Yeah, thank you.
Welcome, Chandrasekhar.
Thank you.
You want to say something before I...
Yes.
Please.
Friends, in the session of tax audit, one will wonder what is role for accounting standards and what is role for auditing standards. It is because of love and respect for Zavre sir, Sharad Baze and Shivram Gadge, or it is for the subject. Let me tell you, at Tax Audit Quality Review Board, we receive various tax audit reports for the purpose of reviewing. And it is noticed by and by that particularly in respect of non-corporate enterprises, the accounting standards are kept at a bay. Let me inform you that compliance with accounting standards by a chartered accountant is mandatory. If he does not comply with accounting standards as well as with auditing standards, then in that case, he is considered as guilty of professional misconduct under Schedules to the Chartered Accountants Act 1949. So, we are of the opinion that ahead of any such untoward consequence being met by a chartered accountant, it is better to enlighten them and ensure that proper compliance of accounting standards is made, proper documentation is made. In auditing parlance, it is said that the audit not documented is not made. So going forward, now you will be looking at agencies like NAFRA, SEBI, and QRB also verifying the audit files of chartered accountants. Although the SQC gives you 60 days time limit for the purpose of compiling documentation, NAFRA is taking a view that after you sign the audit report and you try to compile documentation, this is an afterthought. So the regulators are moving at a great pace, trying to ensure the quality of audit, and also the institute is prescribing accounting standards for compliance. Although they are not mandatory for partnerships, for LLPs, and for other entities like cooperatives, proprietorships, the institute has stated that if those are not complied with by such entities to whom under their act is not mandatory, still the auditor will have to point out the deviation from such accounting standards. So it was effort of TAQRB to bring home the important aspects of these two pieces of standards which are issued by the institute. And we were very fortunate that two learned speakers, Shivram Gadgil and Sharad Vaze, have taken pains to examine these standards, relate them to the tax audit, and bring them before you. Now, friends, we have with us the former council member who was their chairman of Accounting Standards Board for 3 years and member for ASB for all the 9 years when he was on the council. And the Pune, India had got occasion to head the Asian Oceanian Standard Setters Group, comprising of various countries from Asian and Oceanian region, from New Zealand till east part till west part of Asia. So we thought it appropriate that he has also examined this non-compliance aspect, the pitfalls of particularly the small and medium practices where there are certain errors, certain misunderstanding in following those accounting standards. So his concluding remarks will also bring home the niceties of performance, and you will be able to tighten up your belts. So with these words, I comment this session and invite CA Dr. S.B. Zavre for his concluding remarks, and thank you for sparing your invaluable time. Over to you.
Thank you, Chandrasekhar. First of all, I congratulate the entire council for the purpose of formation of the new board, that is Tax Audit Quality Review Board. That was a need of the time, which was essential for the purpose of upgrading the image of the profession. And today's session, you thoughtfully has given a title, Tax Audit and the Accounting Standard. When you talked with me, I was thinking whether I have to link ICDS or whether I have to link AS. Because of want of time, the field would have also, because when we say accounting standard, there are two accounting standard series are there, the AS and the Ind AS. But I hope the Shivram has thought about the timing aspect, and therefore the faculties could not cover about the Ind AS. My professional colleagues, I hope you enjoyed the today's session, because I am impressed totally for qualitative, smart, professional, true and fair answers of the question and answer session by our intelligent, learned and experienced faculties, namely CA Sharad Vaze and CA Shivram Gadgil. Thank you to both of you. And you have given the precise answers and correct answers. And I agree with you. Whenever we are talking about the part of observations in the tax audit report, and something is plus, which may benefit the SEC, which may benefit. I always say, if something is not harmful, but may be helpful, why not to add? And therefore, the adding the positive aspects is very important. C.S. Sharad Vaze talked about, sir, it is in my case, when profit and loss account is prepared and capital gain is added, naturally for the purpose of arriving at taxable income, capital gain is deducted, and that was from equity share, which was totally exempt. By applying the grandfathering provision, it was added again and made the taxable income, and huge amount has been called for. So this is the problem of digitization. But anyway, from long-term point of view, I think the system will improve and there will be no problem. Today's session was primarily on tax audit and accounting standards. My professional colleagues, please understand what is accounting? When we talk about accounting, the recognition, the measurement, and recording in conformity with accounting standard and standard practices for preparation of financial statements. Basically, accounting is the backbone of the tax audit and the taxation. It is a basic subject. But as far as tax audit is concerned, it is primarily reporting the true and the factual information in the prescribed format to the income tax department so that assessing officer will be able to arrive at correct taxable income. This we have to keep in mind. However, I remember I am an old generation chartered accountant of 1973. Basically, at that time, there were very few differences between the taxable income and the accounting income. However, as of today, the gap is widening day by day. That what is the accounting income and what is taxable income, because many notional incomes are also taxed. There are many deductions which may not be available again in the subsequent years. And there are standard deductions too, and the tax holiday profits and gains also. So basically, we have to keep in mind that the accounting is based on financial transactions and taxation is based on fiscal provisions of law. Aim is different. Primary aim is different. But the financial statement is the basic for the purpose of tax audit report. That we have to keep in mind. And decades together, even after the accounting standards were there, actually, what I can say, AS22 was not there. Why AS22? Basically, we are talking about the matching principle. However, till the accounting standard 22 came, there was a guidance note issued by ICAI earlier. Difference between the taxable income and accounting income, we divide into two parts, timing differences and permanent differences. And as far as timing differences and permanent differences are concerned, we create deferred tax asset and deferred tax liability in order to match taxation expense against the accounting income and not the taxable income. So earlier, prior to AS22 or prior to guidance note, this position was not true and fair. But you are aware, there are many provisions under the Income Tax Act. Take the example of presumptive taxation. Now, in case of the presumptive taxation, actual income is not taxed. There is a difference. Whether you are talking about 44E, whether you are talking about 44EDA, whether you are talking 44E, and so on. And basically, one more point we have to keep in mind with reference to section 145 of the Income Tax Act, SCC has a choice to choose either cash system of accounting or mercantile system of accounting in order to compute profits and gains from business or profession and income from other sources. So, can I follow two different bases for the accounting purpose and for the income tax purpose? That this under the accounting, we see you have to follow the system consistently. If I follow mercantile system of accounting as far as accounting is concerned, and if I followed consistently cash system of accounting as far as taxation is concerned, nothing wrong, but every year you'll have to prepare proper reconciliation statements. And even in the tax audit, I think one of the important part is you have to prepare reconciliation statement, especially for the purpose of filing return of income. I'm not talking about the tax audit report. That this is my accounting income, this is my taxable income, and why there is a difference, the difference between the two is required to be reconciliation. You are best aware about the example continued from beginning about the depreciation. Under section 32 of the Income Tax Act, depreciation is calculated under a particular method and a particular rate However, as far as accounting part is concerned, depreciation may be calculated under the different method, maybe a straight line method or maybe a written down value method, but based on useful life of the asset, which may not match with the rate of depreciation as prescribed under the income tax rules. And therefore, my dear friends, very important part we have to always keep in mind, there is a difference between the taxable income and the accounting income, and there are many standard deductions are there are tax holiday gains are there, exemptions are there are disallowables, and there is a taxability of national income. Primarily, our focus on today's session is on tax audit and only linkage of accounting standard, which Shivram has done rightly one by one, and he talked about the various points. I really congratulate both the faculties in this connection. Tax audit is the examination or review of accounts of any business or profession carried on by taxpayers from the income tax viewpoint. That is very, very important. And we have to report in a prescribed format. Please remember, especially my young colleagues, you are not to express opinion. Expressing the opinion is a part of our financial statements. But as far as tax audit report is concerned, I said you have to give the factual information. And to that, Shivram rightly talked about, you may add the observations, right? Which indirectly may be a part of your opinion also, but that may be helpful in that connection. You are aware about the applicability of the tax audit report. I can only say, over a period of time, over the decades, since 1961, when the Income Tax Act 1961 was revamped instead of 1922 Act, the gap between the taxable income and the accounting income is increasing day by day and becoming a concern to the taxpayer, especially for management of cash flow, which is very, very important. Management of cash flow, I said. Tax auditor has to prepare proper reconciliation rather than tax auditor, again, tax preparer, tax report preparer, have to do the proper reconciliation between the financial statement signed by statutory auditor and required data for the purpose of tax audit report wherever necessary, where the my professional colleagues, you have to be more careful where there is no statutory audit, but there is only a tax audit. You have to be very, very careful, and you have to have your judgments and documentary evidences ready with you. Documentary, Shekhar rightly talked about the view of NAPRA. NAPRA was formed when I was a chairman of the Accounting Standard Board, and I had many interactions with the NAPRA chairman and explained various accounting standards by taking number of sessions with the NAPRA officials. However, what NAPRA is talking is absolutely right. In case you require more time after receiving the notice for the purpose of collecting documentary evidences, which is not right. You are aware, documentary evidences is part of our audit process. And therefore, the ICAI Council has considered thoughtfully that peer review of the audit firm, whether from the long-term point of view of proprietary concern also, will undergo the peer review. And therefore, please take care that all the documentary evidences are ready. Needless to say, external documentary evidences has more power as compared to internal documentary evidences. And therefore, all these evidences we have to keep with us as a part of our professional assignment. With this, I conclude my session. I'm thankful to CA Dr. Raj Chawla, the chairman of the Tax Audit Quality Review Board, and CA Chandrasekhar Chitale, who is the vice chairman. And Sharath, you have very rightly given the answers. Thank you. Because after, I can say many years, I heard you today. And my role was to sit calm and quietly and listen both of you. Shivram, thank you. And
Sir,
Over
you
to
are
you,
now
please.
removed.
Thank you. Thank
Huh?
you.
Thank you. Yeah,
Yes.
hold on, please. Hold on, please.
You cannot
Hold on.
forget that.
Yeah. Today, friends, we have discussed about accounting standards and about auditing standards. But let me also touch upon one more standards which, while conducting tax audit, you should be aware, and they are income computation and disclosure standards (ICDS). However, each ICDS states that these standards are not to be used for the purpose of maintaining books of account, and these are to be used only for the purpose of computation of income. So those ICDSs also you should be aware, and I'm sure that in one of the earlier sessions we have dealt with those ICDSs. So, friends, I'm sure that your thought process relating to compliance with accounting standards, auditing standards has been clarified by both the faculties. And to top it up, the closing concluding remarks by CA Dr. S.P. Zavre. Friends, on this topic or on any other topics, if you have queries, please send them to Tax Audit Quality Review Board at our email ID taqrb@icai.in. And we are going to prepare answers and compile them, and we will adequately make you know those answers. I also welcome former chairman of Pune branch of WIRC, CA Kashinath Pathare, who have intently shoulder the responsibility of being coordinator for this particular webinar. And thank you, Kashinath, for your kind cooperation. Thank you. Over to you, MOC.
Kashinath, sorry, I have not taken your name. I have not seen
It's
you in
okay,
the
sir.
picture, but thank you for that.
It's okay. It's okay.
Thank you. Thank you. Thank you, S.B. Zavre, sir, for the insightful and thought-provoking concluding remarks. Thank you, Vasant, Chandrasekhar Vasant Chitle, sir, ji, who is the Vice Chairman, Taxation Audits Quality Review Board, TAQRB, and also the Central Council member, for your kind words and warm introduction. And now over to you, CA Kashinath Pathare ji, the practicing chartered accountant and immediate past chairman of Pune branch of WIRC, for giving the vote of thanks to all of us.
Good evening, all of you. As we bring this insightful session on tax audit and accounting standards to a close, I would like to extend very heartfelt gratitude to each and every one of you for your active participation. Our sincere thanks go out to our esteemed speakers, Sri Sivaram Gadge sir, CS Sharad Vajay sir, Raj Chawla ji, our Central Council member, our Chandrasekhar Chitre sir, and our Guru, past Central Council member, CSB Zavre sir, who share their knowledge and expertise, shedding light on complexities of tax audit procedure and ever-evolving landscape of accounting standards. Your insight have provided us with valuable perspective, which will undoubtedly guide on navigating this critical aspect of finance and compliance. Once again, thank you, all of you, being part of this enriching session. We look forward to future opportunities to learn and grow. Thank you.
Thank you, Manisha.
Thank you. And let me inform that today the attendance was 3,135 as informed by the
Very good. Very good. Very good. Congratulations to board.
Thank
for
you,
your
sir.
being coordinator. Thank you,
Thank you,
Shivaram. Thank you.
Ask and interact with the learned professionals like
Very
Thank you.
you will always join on more occasions.
Ali, sir. Would be really happy.
Yeah.
What your name?
Good night.
Sorry, I joined late.